Today I'll be talking about what to expect for next week, what to kind of do to prepare yourself for next week if we go more to the downside or more to the upside. Um, I'll be talking about why the market has been falling like it did these past days. What can you do to help yourself kind of reflect on that and try to help yourself and not lose all of your money that you have, whether it be short term, mid-term, or long-term investments. I'll be talking about why the market sold off, what can we expect, and what do we do? So first, let's get into it. So why did the market sell off? The market sold off due to the fact that bond yields are rising, that were very shorted by bulls in the market and stock market. So talking about the topic of bond yields, they're basically things that help us buy cars, houses, boats, and basically what that is, it's interest rates. So why does this affect the stock market? This is because bond yields go up and it is harder to buy these things because obviously interest rates go up as bond yields go up, and it's harder for the average person to be able to buy something that's big, because as interest rates go, we were almost at 1%, and now we're going higher. And as interest rates go higher, you're gonna have to pay more interest and more interest, and that obviously leads to people using more money in the economy and wasting more money. Well, not wasting more money, but having to spend more money to be able to get those things that they need, such as houses, cars, maybe whatever it may be. The bond market is to measure and calculate to make sure that inflation is in place and it doesn't overinflate or deflate. So basically, this has affected the market, and you might ask why. Why do we care about that? And that's because it's not because they rose, because this is actually important for the market, so we don't go over what we're supposed to and crash, or we don't go lower and go even lower. So this kind of measures the market. As stimulus goes, we kind of rose as stimulus goes, and that kind of helped the market, just like bond yields do and affect the market. And then basically, what affected it so much and caused this huge drop in the market was the rate of change that happened during the past weeks. Why it climbed so fast, and that's why it happened. That's why we fell so hard. Another thing that I want to be going over is, why did bond yields go up? This is because investors were betting heavy that the economy will go back to normal. And basically, the 10-year bond was supposed to hit what we're sitting at right now, but by the end of the year, not by just in the beginning of the year. By the end of 2020, somewhere in November, October, December, and that's basically what I just said. The rate of change. The rate of change was what affected the market so heavily. And things like the reopening trade, as interest rates go up, energy might go up, gasoline, things like that, industrials, banks, they obviously, banks are gonna bank off of this, because as we go, people are gonna be buying houses, buying stuff, and this is exactly why we saw all the banks rise, because as interest rates go up, they get more money, and obviously they weren't getting that much money because interest rates were so low, if you know what I mean. So investors are also betting heavy on the fact that inflation is going to go back to the normal number of 2% a year, which is right now sitting at 1.4 and 1.3% a year of inflation, as the economy continues to kick back restrictions and things like COVID cases are dropping drastically as we go into the year, and things like stimulus are continuing to rolling out, and also the Federal Reserve said that they will keep this inflation going and kind of put restrictions in place if we do get overinflation or deflation, depending on honestly what happens to the market, how stimulus affects us, how interest rates affect us, not only as in the stock market, but actually in the economy itself, such as jobs and much more like that. So as I was saying, what can we expect from this? So it all depends on what investors are looking for during these past days and coming up in these weeks. So SPY closed right exactly on that 50-day moving average, which if we drop lower, we go onto that 100-day moving average, and it all depends on how interest rates continue to move at, like I said, at the rate of change. So can we expect to move higher that is way faster, or can we just expect that normal move where we get just that slow increase in prices that we were expecting by the end of the year. So maybe we could just drop a little bit and then go, as we were going, and get that 2% inflation by the end of the year. But obviously it's not as people are expecting, because like we said, people are betting heavy on that bond market because people are coming back to reopening trade and thinking, hey, we're going to open back up. We have small businesses open back up. We have, the economy open back up. Non-payroll, non-employment is also a big factor of this, because as unemployment goes lower, we also continue to see that economy opening back up. Our restrictions based on that capacity that we have. Some restaurants 50%, 75% restriction capacity, that maximum capacity that we have. And all of that type of stuff. So also, what do we do? What can we expect from this? Like I said, and how can we prepare? My bad. For any backdrop, or more of a backdrop, or kind of stay ahead of the market here. So I would kind of play the volatile indicators, kind of look at SPY, because it kind of measures like what the market is exactly doing that whole day. Because SPY is the biggest index in the largest market value. So it kind of, if something brings it down that much, then everything will it'll bring everything down with it. Because like I said, it's the largest market value index in the U.S. market. So what can we do? We could play stuff like UVXY if we continue to drop, because that is our tier and volatility indicator. In the stock market, we play things like SQQQ, shorting the NASDAQ. Basically, as the NASDAQ goes down, SQQQ will continue to go rising up. Another thing that I could play is SPXS, shorting the same thing as SQQQ, but it's for the S&P 500. Obviously, that will move way faster because the S&P 500 has the largest market value in the U.S. markets. So as I continue to talk about this, we should just watch that 50-day moving average, which we exactly closed on this last Friday. I mean, if we either bounce off that and continue to go higher as interest rates just kind of calm down for a little bit there. But I mean, honestly, here it's just watching that 10-year bond yield, watching our support levels, our moving averages for SPY. And just being very tedious and careful in what we do in this upcoming weeks. And again, I would not be afraid to buy more of what you're holding. Obviously, things like technology are going to be bumped really hard because interest rates are going up, and technology was one of the biggest things, and innovation was one of the biggest things that we had during this stock market year. And that's because interest rates were so low, and obviously tech is so expensive. Tech kind of runs the world, and obviously they get taxed very hard because of how much revenue they come up with, and all type of stuff like that. So that's another thing. I would not be afraid to add to long-term positions as it comes to that, like Apple, whatever it may be. Short-term positions, would be very careful on that though. Option plays that also expire in the upcoming weeks or days would be also very hazardous thing to keep, as we may drop lower. I'm not saying I'm not like a magician, but I'm saying we can drop lower, but we can rise up back to the top and hit all-time highs once again. It all depends on, like I said, interest rates, the rate of change, what investors are looking for in the upcoming weeks on unemployment, on interest rates, bond yields, non-farm payrolls, and that we have that coming up on the economic calendar on Friday, this upcoming Friday. What the Fed says about these rates, and what they're going to do to kind of not make it a problem for investors and people around the world, because as interest rates go up, the dollar will go up. And obviously this is to kind of move the dollar and make sure that it doesn't go over where we're supposed to be or below where we're supposed to be. As I said, inflation is 2% a year. So that'll be all, guys. Thank you so much for tuning into this video. I hope that it really helped. And I'll be coming on next week again. Please comment below if you'd like me to review any stocks that that you like. And yeah, make sure to drop like, like, comment, subscribe, and thank you so much for your